You bring an adult to a swimming pool that never swam in the past. Give them an entire book. Let them read a book about swimming. Have them dive into the pool and let them swim a lap. The biggest mistake anybody can make going into real estate, buying a single family home and becoming a landlord. That 8% is no longer 8%, it's actually 5 to 6% instead. It is uncertain, it is volatile.
I bought 2 single-family homes as my first real estate investment. I hired the wrong GC. I went through 2 hurricanes, and I've heard it from other people that have invested in single-family homes. It's like too much headache.
The biggest mistake high earners make is they place it into a savings account, or they place it into a money market account yielding 3 to 4%, or they're giving it to their financial advisor at an average of an 8% return.
Are we talking about the mistake being investing in a single family home or investing just due to hype? You're seeing it on social media, and all these influencers are making it look so nice and clean.
Investors that still invested also during 2020 COVID-19 crisis, those 2 periods are anomalies. The past should not predict the future. It is time to switch strategy. Top 3 to look at when choosing a sponsor: financially stable. Secondly, an experienced sponsor. And thirdly,
This is the Cash Poor Asset Rich podcast. I'm Michael.
I'm Amr.
We break down real estate in a way that's simple to understand
Easy to relate to.
and practical enough to act on.
Let's get started.
Okay, so someone can obviously the high earners, someone making a lot of money can make mistakes because I'm assuming they're not the intelligent investor at the end of the day. Maybe they are, maybe they aren't. But as far as mistakes, we learn there are 2 types of mistakes, direct and indirect. And people that direct, meaning you're making mistakes are yourself, you're learning from. I'm all for mistakes because that's how you build wisdom, as long as you're learning from it, right? So, and then the indirect is learning it from others. And in today's episode, we're going to be talking a lot about kind of like more of the indirect, unless the listeners have experienced some of the mistakes that we're going to be talking about on their own. But what would you say are what are the biggest mistakes that you've seen happen in terms of, well, let's go with one mistake. Sorry. What would you say the biggest mistake that you see consistently happening with investors?
It is as bright as day.
Okay.
We talked about high earners earning 200,000 to 300,000. Our examples in previous episodes were $300,000 a year, and we talked about how much of that goes towards lifestyle versus how much of that goes towards savings. And we're primarily interested in just the savings portion of it. And the biggest mistake that I see high earners make with their savings is they place it into a savings account, or they place it into a money market account yielding 3 to 4%, or they're giving it to their financial advisor and having the money invested into the stock market at an average of an 8% return. And that 8% return, after you realize the gains, if you do sell those positions and you are at a 35% tax bracket, all of a sudden that 8% is no longer 8%. It's actually 5 to 6% instead. And it is uncertain. It is volatile. The principal can fluctuate dramatically based on those market positions. And most importantly, is there is really no other incentive beside the appreciation of the stock, as well as any dividends if the stock pays out any dividends. And we talked about 4 pillars of income that comes with real estate, which is a loan pay down, distributions from rents, property appreciation over time, and property depreciation from a tax perspective. So if you see, you're comparing an income vehicle that can potentially generate 4 different avenues of income in real estate versus two avenues of income on the stock market, which is dividend and the appreciation of the stock. And I'm mentioning appreciation of the stock because I want to make sure that I'm comparing apples to apples, that real estate will appreciate and stock will appreciate. So this way we have a fair comparison. It's half of the yield that real estate would yield because you're comparing four different income vehicles versus two income vehicles. And most importantly, there's really no tax advantage whatsoever in the stock market or money market yielding account or a checking account yielding any interest. That is really the biggest mistake that I see high earners do it. And they do it just because it's the path of least resistance, right? It's very
Yeah.
easy to contact Charles Schwab or contact Fidelity Investments or contact your local real stockbroker or investment firm and say, "Hey, I have 20 or $30,000 that I would like to invest, and how can I invest that money into the stock market or any type of securities?" Just very, very easy to do, and this is why this mistake often happens because it's the path of least resistance.
Got it. Okay. So now that is in terms of the type of investment. What if, for example, I'm a listener and I agree with you. Okay, that's a mistake that I've made in the past, learned from it, and I started investing in real estate, but I made a lot of mistakes. What is the biggest mistake you see investors make when they come into the game of real estate?
Okay. And that's in my opinion, is buying a single family home and becoming a landlord. That is the biggest mistake anybody can make going into real estate is they think that
Hmm.
it's going to be on autopilot. They buy a property, they rent it out. Life is great. Out of the rent, they pay their mortgage, they pay their taxes and insurance, as well as any maintenance that comes along with the property, and they will positive cash flow. Reality, that's not the case at all. Investors end up dealing with unruly tenants. They end up dealing with evictions, vandalism of the property, not taking care of the property as they should, late payments, late rent, notices from the association if they're part of the condominium because their tenants are violating association bylaws, trash being left outside, not being picked up, association violations for other ordinance that happens within the association based on the bylaws. And they think that they're making a 5 or a 6% return, but when you compound all of these issues that we are discussing on this call, the return is diminished dramatically.
Okay. Are you referring to, so I totally understand what you're saying because I've kind of been through that and I can discuss that a little further, but are we talking about the mistake being investing in a single family home or investing just due to hype? Like where you're seeing it on social media and all these influencers are making it look so nice and clean and everything is just in a perfect world, and they're not talking about all the mistakes they're making and all of the issues that you mentioned, or are you specifically talking about those issues versus an actual single family home?
I'm talking about those issues versus an actual single family home.
Got it. Okay.
Just back to what I was saying earlier in the episode, the path of least resistance. Why do investors
Hmm.
go out to the stock market? Because it's easy. Similarly,
Sure.
with single family homes are easy to acquire. They're the easiest. They're the easiest asset class in real estate to acquire. All it takes is to go on Zillow and or realtor.com and take a look at listings yourself. You can contact those agents without having any representation from a broker and
Yeah.
just represent yourself. There's more residential realtors out there than citizens in my opinion, and everybody wants
Yeah.
to sell homes. So it's really easy. Most of our listeners have somebody in their family or have a cousin or a friend that is either a part-time or a full-time realtor. And
Mhm.
when they have a little bit of savings, the very first thing they want to do is they want to contact the realtor they know. Could be based on social media hype or it could be based on relationship and
Sure.
asking that realtor to begin looking for a real estate investment for them. And what that realtor does is they'll go out and they'll find them a single family home. Typically, it's a vacant property And then once that property is closed, they will try to find a tenant that would occupy the property on a 1, 2, or 3 year deal. And here we are. We have a tenant that's in a single family home paying rent. So it's really the easiest. By comparison, when you look at commercial real estate, which has higher yields of returns, higher appreciation over time, it requires a higher level of sophistication. You got to understand the fundamentals of how to underwrite a deal, how to underwrite risk, how to look at uh, a single lease if it's a single tenant property, or if it's a shopping center or a multiple tenant property, such as an office building or any type of multi-tenant industrial. Now you're looking at multiple leases within the same premises, within the same real estate. You gotta underwrite cash flow for the next 10 years. You gotta be able to provide a pro forma to a lender in order for you to get proper lending on it. You have to come up with equity. You have to go and source debt. There's a higher level of sophistication that most first time investors are just not in tune with. They don't understand it. They don't want to learn it, and as a result of that, they get caught up in the realm of the single family real estate that's out there that's available for rent, or potentially could be a single family real estate that they would buy, rehab, and flip.
Yeah. So I mean, is a lot of it is also like are you going to be the person operating versus are you just going to invest and let your money kind of run with somebody you trust? Like for me, I before I got into the example that we're giving here is, I bought a single family. Actually, I bought two single family homes as my first real estate investment. And yes, it was due to hype, obviously, not just hype reading books like Rich Dad, Poor Dad, and kind of understanding it from their perspective. And even though they talked about some of the mistakes they made and what to expect, it is a whole different ball game when you get into it yourself. I mean, I hired the wrong GC. I went through two hurricanes, and a lot of people when they get into stuff like that, especially when you take on something and you have a lot of other things going on in your life, it's just, and I've heard it from other people that have invested in single family homes. It's like too much headache, too much headache. And that's all I can continuously, that's all I hear is like, it is way worse than what I actually thought. And they just, it doesn't go through and they end up either selling it and getting out because they had a bad taste in their mouth. And to me, I built resilience and I made a lot of mistakes when I purchased those single family homes. But my idea and my thought process was a little bit differently going into it. Even after it, I said to myself, "This is I'm kind of happy that I made these mistakes because it was almost like a first row seat for an amazing masterclass, and that I still had." At the end of the day, you still really do have a real estate property. So that's the beauty of real estate. You still have something tangible at the end of it all, but it doesn't mean that you're just going to go into it blindfold and just make all the mistakes in the world. That does not mean you have to have some level of some calculation into going into the deal. Like you mentioned, underwriting. It's such a crucial part of before you buy a real estate deal or invest in it. Because if you're not understanding, if you can't really explain it to somebody or to yourself, then what are you really investing in? Just by hype or somebody telling you, or like you said, family, friend, a realtor telling you, hey, you should buy this deal, or fear of missing out maybe because you hear it, everybody is in real estate and you want to be in real estate, but you're making potentially a bad decision. So going into that, let's say, for me or for even someone making a lot of money that has already a job, they're busy. It's one thing to be smart. I mean, we're talking doctors, lawyers, anyone that has a good type of income and they are sophisticated in their field. Let's put it that way. It doesn't mean that they're going to be sophisticated in real estate because it's a completely different animal. So do they what do you suggest for someone like, let's say they want to, how do you trust someone? If I wanted to invest, give my money to somebody and be like, okay, I want to be out of the game because I'm busy. I'm very busy every day. I don't have time to do what we just talked about, all the mistakes, all the issues. I just don't have time for that. I'd rather piggyback on someone else that has had that experience, that know what they're doing, and I wanna kind of like just let my money go and have that. But even with that, you still have to have some level of understanding of what you're investing in and who you're investing with. So, what are some like red flags that a person, should understand before trusting somebody to invest with them?
I'm gonna dive thoroughly into your question, but
Okay.
I wanna start with an introduction to what I've seen over the last 16 years, specifically in single family. Some of
Okay.
our listeners are experienced real estate investors that have done well in single family by managing it themselves, by buying and selling. And those experienced investors may have started their real estate journey back in 2008 and 2009. Investors that were able to invest back in 2008, 2009 crash, and investors that still invested also during 2020 COVID-19 crisis. The last 15 to 16 years is very, very unique in a sense that we haven't had an appreciation in the real estate market probably since the Great Depression in the 1930s. And millennials, which are our investors that most likely have invested during this time, could be some Gen Zs that were able to also capture the COVID 19 investment boom, let's call it, have really benefited from that environment during a period of unnatural appreciation to real estate values.
Okay.
So they right now they're looking back and they're saying, well, you know what? These guys are talking about single family and they don't think single family are good investments, but here I am. I've invested into single family in two cycles, in the 2008 crisis and the 2020 COVID, and I became very rich because of those two cycles that we've experienced. Well, looking to the horizon, I honestly look back at those two periods and say those two periods are anomalies. Are we going to really base our investment strategies and our investment projections on a crisis that may happen? Are we going to say, well, you know what, the Iran war and the United States war is going to create a real estate crisis, and I'm going to be ready on the sidelines with cash to be able to buy single family because I think that single family is just really easy and something that I'm comfortable with and something that I've made money with in the past during the 2008 crisis and the 2020? Well, guess what? I think that we all want a crisis because there is opportunities in every dislocation, but a savvy investor should not think like that. So the past should not predict the future. If you have made a great amount of money during the 2020 COVID and the 2008 crisis, it is time to switch strategy because, in my opinion, looking at the market, I think there is no appreciation to residential real estate at this time. I think our values, and I'm talking about our market here specifically in Michigan, our values are capped. We're not seeing appreciation in residential real estate value, very, very little appreciation, if any. In addition to that, our rents are capped as well. We haven't seen a rent bump for the last few years right now. As a result of that, I think, the cause of not seeing a rent bump is due to the lack of disposable income and the lack of salary increases to keep up with inflation. Cost of living in the last 5 years has risen dramatically. And as a result of that, we were not able to really increase rents at the same rate as the increase of the cost of living. So there's some capping going on. Specifically, also looking at the Midwest market, whether it's Ohio or Michigan, those states are not growing in population. Okay, so there's really no growth. And there's some geographical reasons why this growth is not happening. Specifically, Michigan is a peninsula and Michigan is away from the crossroads of America, let's call it, whether it's states like that are growing, like Indiana, for example. Indiana geographically sits in a much better and a much more sensitive location than Michigan. In addition, doing business for large corporations in Michigan is difficult. Having availability of ready pads for companies such as AI companies to come in and do business in Michigan, we don't really have that infrastructure. To compound that issue also, weather is a problem over here. Weather is difficult over here, which makes it less and less attractive. So we're in a market that is not really seeing a lot of appreciation in terms of real estate value and in terms of rent increases. And as a result of that, I would not hang my hat on the future on the past success that I've had during COVID-19 and during the 2008 crisis. It's time to change strategy. It's time to really look at other asset classes such as commercial real estate.
Okay. So are you saying like pretty much kind of what we talked about, hype? Because that, to 2008, potentially after the aftermath of that and how people got, made a lot of money in that game, is now you're investing due to hype. So you're seeing what other people are doing and you're like, okay, they did it, right? And it was, but there was a reason to that. There was a reason they got to where they were at, which was still, in my opinion, 2020 is unexplainable how everything just shot up. But I totally agree. So is it, so now you're talking, you kind of hit a point where the, indirectly we're getting into like the residential side versus the commercial side, and we kind of talked and touched based on that in previous episodes. But the residential side, you're basing your, which is one of the things as far as the appreciation side, is almost uncontrollable unless you do all the homework you can, and you go into a market and hoping because it's been growing or you hear that a big tech company is going there, you're assuming or based on your calculated risk or investment, you're hoping that single family homes based on comps are going to go up. And that's out of your control. Versus a commercial investment, you can kind of dictate that outcome because you can control it goes by income versus comps that are sold in that area. Is that correct?
That's exactly right, and that was gonna be my next point, and you actually hit on it because when I was talking about the capping that's happening in residential real estate, some of our listeners may be thinking, well, the reasons that you just mentioned, whether it's the situation in Michigan, population growth, et cetera, wouldn't companies and having availability of infrastructure to bring new companies into the state, wouldn't that also affect commercial real estate? Yeah, it could affect commercial real estate. Commercial real estate is not really valued based on comps, it's valued based on income. And when we look at the leasing structure, and if you look at a good property will have leasing structures where it would have long-term releases and it would have escalations in those leases. As those leases escalate, so does income, so does the value of the real estate.
So it's almost predictable, obviously. Like if you're putting in the risk, nothing we talk about is ever guaranteed. Nothing in life is guaranteed, period. So um investing in commercial can have a better impact. Doesn't mean like single family residential is a bad idea. Obviously, a lot of people have made money. I'm making money from it, but it's more, if we're talking control, it is more controlled on the other side. So now that we understand this, now that we are like, okay, let's call it the commercial side. Even somebody investing the commercial side, a ton of mistakes can happen if you're individually doing it versus like, is it better to invest with someone that knows what they're doing versus doing it on your own?
I mean, there's no difference between having a third party that's managing your money in real estate versus having a certified financial planner that's doing your life insurance policies, or that's doing your college funds, or that's managing your your stock portfolio. You're trusting a third party to do that work on your behalf because of their experience in their field of work. Real estate is no different. If you're trusting a certified financial planner to manage your life insurance policy and manage your stock portfolio, why wouldn't you trust a experienced real estate operator to manage your real estate portfolio as well? No difference.
Yeah. But here, to your point, I think, what we talked about, least resistance. To me, even the financial someone that's managing your stocks, for example, regardless, I don't personally, I can't stand that. And the reason I say that is because every time I talk to somebody that is having their portfolio being managed by a financial advisor, their returns are like, they always tell me, on average, we make about 8, maybe 10% annually. Well, you know, why why bring in a financial advisor, paying them to manage something I can just buy S&P 500, which historically has shown a return of 8 to 10% and having it just ride the wave. I think real estate is way more sophisticated or way more complicated than just giving it to a financial advisor versus somebody that you're investing in, because there's a lot more that goes into it. And that's what I'm like, to me, like we talked about single family homes. Imagine investing in a commercial property and how much more sophistication needs to go into that. And that's what I would love to like touch base. Like, okay, you are, you want to invest, you have $100,000 to invest as an example. And to me, okay, single family, we already kind of touch based. It could come with a lot of headaches that the social media influencers or the hype that brings in. And you were like, whoa, this is very different than what I have been reading about or watching TikTok videos about. What can go into making a lot of mistakes into the commercial side, investing yourself? And then I would love to talk about how do you pick the right person to invest with, and what is the difference between the two, whether you invest yourself or invest with somebody else.
So there's really two ways to invest in commercial real estate. You can three ways. Let's
Okay.
cover all three ways.
Sure.
You can go and buy yourself a commercial property.
Okay.
Try to figure it out. Hire a property management company that's going to do day to day work for you, manage your leases, manage your accounting, collecting from your tenants, taking tenant calls, taking service calls. And what they're not going to do for you is they're not going to do asset management. There's a
Mm.
huge difference between property management and asset management. We'll talk about that down the road, though. So that's option number one.
Sure.
Option number two is you
But
go.
just high level, give me what the difference is. Just really, really high level, 30,000 feet in the air. What is the difference between asset management and property management? Just since we already mentioned it, just so we understand.
So your property manager is not going to tell you how to buy the asset, what to buy it for,
Okay.
how long
Okay.
to hold it, when to sell it, type of capital improvements that you should reinvest back into your property, negotiate new leases, negotiate renewals, hold the property management accountable, and making sure that the property management is performing. That's
Okay.
really what asset management is.
Okay.
And that is very, very critical to the success of a commercial real estate investment. Without asset
Absolutely.
management, property management is not enough. You know, we've taught you and I worked on a deal together just
Hmm.
recently. There's a property management component, but the property severely lacks an asset management component, and as a result of that, the property is distressed
Yes.
because the
Yes.
proper asset management is not there. It is also an example of an owner that wanted to buy their first commercial real estate investment, and they wanted to figure it out on their own. But as a result of it, because the lack of experience asset management is not present, the property was continually distressing year over year since the acquisition. So
Got it.
property management
Okay.
alone is just not enough. The
Understood.
second way to invest in commercial real estate is you would go with a publicly traded real estate investment trust, also known as a REIT.
Okay.
Blackstone, as an example, Ramco, Brixmor. There are a lot of publicly traded real estate investment trusts where you just buy their stock and you would invest into real estate indirectly by buying their stock. You do not have control over their decisions. You're not part of any of the decision making. You're not being informed. Beside just looking at quarterly dividends and earnings, or monthly dividends, or quarterly dividends, or annual dividends, or the quarterly earnings of the company. It's all really that
Do
you have
those
control.
give the same benefits as like the Fantastic Four that we always talk what we always talk about? Do those REITs give you the same benefits as if you would invest in a real estate versus a REIT?
I honestly, I'm not versed on whether you do get the same benefits of the Fantastic Four, because at the end of the day, you're buying a stock, right? So in logically speaking, when you buy a stock, the stock market rules is what it really applies to you. So I would say, just from looking at it from a 30,000 square foot view, that you may not get the same benefits as you do if you are on the deed of the property that you're buying as a limited partner or as a general partner. You're just not deeded that property. Therefore, at least the depreciation benefits and the ownership benefits is just not there. But this is just
Okay,
me speaking from logic. It's not really speaking from experience, because I've never invested into a real estate investment trust. Beside knowing that the product exists, I'm not very versed about what happens underneath the hood of that product.
got it. Okay,
The third way to invest into a commercial real estate asset is through a syndication, which is really what I do. And what you do is, we run a syndication platform, and that syndication platform is raising capital based on a deal by deal basis. So we have a deal available. That deal gets underwritten. It goes through our process of underwriting and identifying this deal, if this is a tangible deal. And then we go out and we secure the loan for the property, and we secure the equity through a partnership or a syndication, which is a pool of investor money being put together for the purpose of buying real estate. The partners that do invest into the asset have deed and ownership rights of the asset. Therefore, they benefit from the Fantastic Four that we've been discussing on our episodes. And in my opinion, I find this to be the most effective way to invest for several reasons. One is you have the benefit of ownership. Two, you have a single point of contact that you could talk to at any time about the property, who's basically acting as your owner rep. Three, you are not investing into a fund that has tens, maybe hundreds of assets, depending on how big the fund is. You are investing directly into a single asset. So that single asset, you know the mechanics of what is happening with that single asset through your monthly reporting that you receive by the sponsor and their team. You're in tuned with the balance sheet. You're in tuned with the personal finance, or with the financial statement on a monthly basis of the asset, because you're receiving a monthly report. Your monthly report includes a general ledger, so you have full visibility of the accounting. You're looking at the payables. You're looking at the receivables. You know exactly what is happening with that asset as of you are operating it, but you don't have the burden of the operation. So you're very, very close to how that asset is performing. And I find that to be very effective for our our high earners, because our high earners are busy doing what they do at their job.
sure.
They have owner representation by an experienced operator that's doing most of the heavy lifting.
I got you. And so those are the three. Pretty much either you do it yourself, going into a REIT, which I kind of was reading a little bit right now about it. It's not compared to a right. It's not, you don't get all of the benefits. You get some, but very minimal. And then the last one, which is investing. So it could be whether it's in syndicator, or it could be a family friend that is, hey guys, we want to raise money. We're buying. I don't want people to kind of get caught up on the word syndicator as a big hole. It's literally just investing with somebody else that you have trust in, and believe that they're going to do a great job on that asset class, or that real estate property. So now let's say I want to invest the $100,000. How do I trust that person, whether it's a syndicator again or a family friend that knocked on my door and said, "Hey, hey Michael, we have an opportunity for you to invest in for $100,000." How do I trust? Obviously, this is a family friend versus let's say an actual syndication company. Um, how do I trust them? How do I know when I wire my money to them? How do I know they're actually like? What should I look for?
Great question. Track record, in my opinion, is the most valuable attribute to a experienced syndicator or a sponsor. You got to look at their track record, how long they've been investing in real estate. What is their success? Have they've gone through a full deal cycle? So what is a full deal cycle? Is an acquisition, post-acquisition management, and an exit. Do they have a full deal cycle under their belt? Or are you their first full deal cycle? If they have a
Okay.
full deal cycle under their belt, that gives you a level of comfort that this sponsor has gone through what it takes to acquire, manage, and sell in a real estate asset. Because we can't own real estate forever.
Yeah.
A lot of our listeners really understand the fundamentals that there is an entry point, just like anything that you buy and sell, any type of good that you buy and sell, whether it's gold or whether it is stock, or in our conversation here, it's real estate. There's an entry point, there's an exit point, and there's a holding period in between. How long is that holding period, depending on the business plan that asset is directed to do? Therefore, there's a lot involved during that holding period. And when you look at an experienced sponsor that has gotten through thick and thin of what it takes to hold a real estate, the ups and downs, the lease renewals that happens inside of a real estate investment,
Sure.
the tenants that have not paid the rents and how to handle that without creating a vacancy, capital improvements that were just not really anticipated on this property during the underwriting period, and all of a sudden you've got a new parking lot that you got to deal with, or a new roof, or new HVAC equipment, or a tenant not renewing their lease, and then now we have a vacant unit. How do you go to market, what to offer, and tenant improvement allowances, or who to pick as your real estate broker for representation? Do you have any direct point of contacts that you can contact, because you know that a box of that size could be a great fit, for example, for a Jersey Mike's? Do you know the broker of Jersey Mike's that you can contact directly and try to backfill that space? So those are the experience that is required to successfully manage a commercial real estate asset. And I think for a first timer or a second timer or even a third timer, going through that may be very cumbersome if they do it on their own. And this is why it is very recommended that when you look at a sponsor, you look at their track record, and you also got to make sure that your sponsor is financially stable. I think that's very, very important. Um, as a sponsor myself, I like to align with our investors. I believe in skin in the game, and when your investors are seeing that the sponsor believes in the investment, believes in the asset, and has skin in the game, and they are invested, even if they're invested at a 5% or a 10% or a 15% or a 20%, they have skin in the game. They are aligned. Their interest is aligned with the interests of the investors. That's very, very important.
Yeah.
So to summarize it, I would say top two things that you want to look at when choosing a sponsor, or top three to look at when choosing a sponsor:
Okay.
somebody who's financially stable. Secondly, an experienced sponsor that has gone through a full deal cycle. And thirdly, a sponsor that's willing to align with their investors and have their own skin in the game.
Okay. The first one that you mentioned, financially capable, how do you, as an investor, how do I make sure that happens? Or obviously the second one, as far as the experience goes, and the third one, skin in the game from the sponsor. But the first one, how do I know in the beginning before I even get deep into it? How do I know they're financially capable or
You, you,
backed or whatever?
So you mentioned that it is a friend or it
Sure.
is somebody that approached you. Uh, Based on the personal relationship, you would know
Sure.
if that individual is financially capable or not.
Got it.
If it is a stranger, you can ask the question directly. You know, in the
Okay.
event that you need to step in as a sponsor, do you have the financial capability to do it? You know, do you have the cash backing to do it? If you don't have the cash backing, are you a sponsor that can leverage their balance sheet? Let's say you have your cash poor, but you're asset rich. Are you able to leverage your balance sheet to show that you are capable of performing? Because when we're looking at loans, the sponsor that's sponsoring the transaction has a huge burden to really pass the litmus test with the lender. The sponsor is going to be the one that's providing their financials and their balance sheet to show that they are capable. So you don't want to really partner up with a syndicator that's not able to show that, because if they can't show that, what's going to happen? They're going to bottleneck the process while they're searching for a loan. They may tie up a deal, but once they are looking for a loan, they may bottleneck the process because they just don't have the cash on hand or don't have the balance sheet to be able to support the debt.
Yeah, even the experience side, like if you're investing with somebody that doesn't have experience, you're pretty much going to back to all the mistakes that we talked about earlier. Even though even they could have read all the books in the world and understood how the process works, but it's very different than you actually being in the game and doing it yourself. So you're actually like investing and being the guinea pig part of the,
You,
which there is nothing wrong with that. It's fine, but you're taking more of a risk.
you bring an adult to a swimming pool that never swam in the past. Give them an entire book. Let them read a book about swimming.
Yeah.
And once they're done with that book, have them dive into the pool and let them swim a lap. Can we
Yeah.
all agree that they're not going to be able to and they're going to most likely drown?
Absolutely.
It's the same
Yeah,
thing.
totally. Totally, totally. Okay, well, I mean, most mistakes, like, I don't wanna say they're complicated because they aren't. It's more like they're avoidable. If you learn and understand what the mistakes are, you can avoid them, kind of like what we've been talking about. So, our next episode, so now if these are the mistakes, what should you actually look for before investing? And that's gonna be our next episode.
Well, that's we're going to dive into the mistakes of investing on the next episode. I think we've covered a lot of great material on this episode, so stay tuned for the next one and let's go through those mistakes.
If you got value from this, do something with it.
Subscribe
Ask better questions
and stay consistent.
because building assets isn't about one big decision.
It's about disciplined and calculated ones over time.
If you know someone who earns well but isn't building assets the right way,
Share this with them.
this is the Cash Poor Asset Rich podcast. I'm Michael.
This is Amr. See you next time.